So welcome to everybody, Bruchim Habayim, and welcome to those of you who are coming for the first time. I think most of you, the majority of you, have been with us before, and I'm your host, Yitzchak Hutner. And so first of all, it was important to start, since we're doing this through the AACI, to thank the AACI for making this whole thing possible. In particular, to thank Leah Rosenzweig. She's doing all the technical support for the seminar, and also to Ilana Wiesel and Carol Raymer. I hope I'm saying your names correctly. At the AACI, you put together all these things that help make the presentation possible. So thank you again. Thank you, AACI, for your help and your kindness. So by the way, everybody should realize that it's being recorded and it'll be available also on YouTube in the next few days. So if you want to be able to get it again or be able to forward it to somebody else, you're welcome to do that. Please feel free to do that. So basically, I think we have it set up tonight. The meeting is structured with a PowerPoint, right, which will also be, everyone will be receiving a mailing after the seminar sometime later this week, presumably. So we're not going to be going over all of the details, but the basic goal, I think the way Mark outlined it, is to be able to give us like a menu of issues that we want to discuss further, or to help us to make critical decisions. The other thing is, one of the guests that we were supposed to have here tonight, Binyamin Zucker, a financial advisor and a legal expert, unfortunately won't be able to attend, has a family health matter. So we wish him and his family a refuah shlema. So Mark, you're going to be carrying pretty much the ball all the way through. Mark will be able to explain and give background to many of the slides that we're going to see in a moment. And also we're going to be bringing to the program in a little while a guest speaker all the way from New Jersey, Larry Solomon, from the company of Melrose Solomon. And then at the end, you'll be able to ask all your questions and hopefully be able to get some reasonable answers. So by the way, if you have any questions that you want to ask, you can keep using the chat button at the bottom of the screen, and then we'll be able to follow up. And if there are some questions that are more personal in nature, we'll be able to follow up with everybody separately and individually. I think everybody now is muted, so if you'll have questions, you want to make comments, as I say, just use the chat. So why don't we get started and turn it over to Mark van Gelderen.
All right, so this will take a little while. Some of these slides we're just going to gloss over for you to be able to read and understand them on your own, or if you have questions, to get back to Yitzchak, myself, or Binyamin. So let's get started. We have two situations happening right now that are making life difficult for many of us. We have inflation taking off, and they're telling us that we're entering a significant recession. So when this happens, we need to think about our finances differently. So in a minute, we're going to be talking about the math and these various other topics that are here. So can we go on to the next page? Before beginning, need to remind you that nothing we say here is a invitation to buy, a recommendation for what you should do, and you should not make any decisions solely based on what we're talking to you about. You need to talk to lawyers, accountants, financial advisors, and you need to make sure that the situation fits your needs and what you want to see happening in the future. So first thing we need to talk about is to understand how destructive inflation can be. There's a simple constant that is not totally accurate, but gives you a ballpark result as to how inflation works. So if inflation was growing at 10% a year on average over a number of years, it means that your buying power you would need twice as much money to buy the same amount of goods in 7.2 years. If, on the other hand, you want to look at it the other way, that inflation is destroying your buying power, you divide 10 into 72, and it tells you that in approximately 7.2 years, you have halved your buying power, meaning if you have the same amount of shekels or dollars or euros, in 10 years, it's only going to buy half as much. So let's go on to page number 3. Okay, so let's do this as a practical example. We have an example, a fictitious example of a lady at the age of 70 who is bringing in from her Social Security, Bituach Leumi, pensions, etc., about 16,300 shekel per month. If there is, on average, 6% inflation, which is lower than the current inflation rate in dollars, and half the current inflation rate in sterling, if inflation continues at around 6%, starts with a budget of 14,000 shekel, and because of inflation, after a year, she needs to buy the same amount, 14,840, and after 2 years, she would need 15,730, and we can see that already after 2 years of 6% inflation, she's almost at the place where her fixed amount of shekels is causing her to not have enough to pay all her bills. So not only that, but a person at the age of 70 is expected to live today until around the age of 90. But in terms of managing money, because half the people live less than 20 years and half live more than 20 years, it would the money available, meaning this $100,000 that's up here in savings, needs to last until 105 so that she doesn't run out of money in late retirement years, because the older we get, the more difficult it will be to get out of our rocking chairs and to be able to come up with cash that didn't exist before by taking on a job. Okay, let's go on to slide number 4. Hopefully I won't botch this next one up so badly. Okay, so there are factors working against retirees. Fixed income programs, pensions, Bituach Leumi, social insurance, etc., do not keep up with inflation. The only way that those programs can fulfill their promises is to go and use statistics that are at a lower amount than the actual inflation. So at the end of the year, we will probably see that people who are on pensions or Bituach Leumi or American Social Security will get an increase. But inflation may be 6%, but the increase might only be 3 or 4%, which means that each year that you continue, you're going to slip behind in terms of buying power. People in retirement don't have the luxury of having a lot of extra cash to use creatively. The cost of living for retirees inflates faster than general indices. And that's because as we get older, healthcare and other costs become a much greater part of our budgets. And those areas tend to inflate faster than the general economy. And as we already mentioned, the ability to generate part-time income reduces with age. Let's go on to the next slide. Okay, so for several people who may be connected to this seminar, this can be really scary news that there just isn't enough money to go around. So let's go down to the third suggestion. Where do you go for help? It's one of the things we do at the Financial Resource Network, but also the AACI has counselors, Nefesh B'Nefesh has counselors, and whatever municipality you live in Israel, they have a social work department that is taking on clients like yourself to help you get through financial difficulties and understand what resources might be available to you through the 4,000 nonprofits in Israel that work in the area of healthcare, food assistance, and so forth. Clergy, friends, family. Okay, obviously, if they're in financial or potential financial difficulty, has to get help with budgeting. We can send you to some people who can help you with that. And on the other hand, the reason why everyone should have an emergency fund or work on one if they still can is just because of these kinds of financial emergencies. Let's go on to page number 6. All right, there are a couple of things that everyone should do that are not related to tonight's seminar, but are really important. One is to have a continuing power of attorney here if you are here in Israel. It is something very different than what is available in the United States and Canada. It has an equivalent existence in the UK, but does not exist, as far as we know, in any other countries except for the UK and Israel. The justice ministries of both countries worked on this for many years, and about 5 years ago came up with something unique. You should have an active care plan, should have a schedule of doctor's visits, people who can check in on you on a daily basis if you're living alone, and to make sure that one, as they get older, should have an active social life, which reduces dementia. Another area in retirement is safe-proofing the house, making sure that your health insurances are properly set up, where we can refer you to experts on that area if you need help, and someone who can independently check whether you are suffering mental decline. One of the things on this is, having been working with people in retirement for over 30 years, one of the most interesting and potentially dangerous assets that one might have is my guy or gal or group, meaning that someone who will take care of you or drive you around or whatever if you're not doing well. If you're having a situation or developing a situation like this, you need help to think it through, because my guy, gal, or whatever it is not trained to be a caregiver for elderly people. And unless you have them checked out or trained, there will be problems in all likelihood. Okay, wills, most people think about, and the emergency fund, as we mentioned earlier. So let's go on to page number 7. Okay, page number 7 is talking about the Israeli continuing power of attorney law. I just want to spend a minute talking about it because it's an unbelievably flexible document that you decide what you want. You can decide when you need help, and if you get better, how it's immediately suspended. but still exists for future use if necessary. You're able to have different people in charge of your quality of life, your health, and your financial decisions. However, you need to have someone in Israel who can do the signing and ordering. It can't be run from someone abroad because they can't sign off on things from abroad. There has to be a live signature. However, you could have people working for you who are under the guidance of someone abroad. One of the most interesting things about this continuing power of attorney law is that it continues for 90 days after death, meaning that the people who are taking care of your quality of life and financial powers in particular are able to go and clean up everything before they lose their powers, which nicely overlaps with wills, or in many cases means a will is not necessary. In our opinion, continuing powers of attorney are much more important than a will. The only people who can help you do it is a qualified lawyer who's taken a course on how to do it. It does take time to put together, and it does cost money, but it is worth the cost. And we can steer you to lawyers who have done well doing this for other clients. Okay, let's go on to the next page. All right, page 8. The traditional financial planning rule. Now we're getting closer to talking about investing, but getting back to the idea of why it's so important to rethink investments if you have any control over them. So standard thing is that if a person is in retirement mode, there'd be 20% in blue chip shares and 80% in safe yielding bonds. Problem is that the bonds are giving a return that is well below inflation these days, and the stock market isn't doing terribly well, especially right now. But in most cases, a portfolio like this is going to get at least 3% negative returns a year just because it's not able to keep up with inflation. I'm not going to go through the numbers right now. You can study it more at home, and we can discuss it later or after the class if you need further help. Let's go on to page number 9. All right. One of the first things that comes up when we talk about investing is risk. And risk can be defined in 2 different ways: volatility and permanent loss. So here's a share that has had bad results going through to the end of 2021. I'm not showing what has happened this year, where it's come down almost as far as it was at the lows of 2020. But it will return because the business model is solid, the company's making money, etc., as opposed to another company that is not, it's a startup, it hasn't been successful in the last couple of years, and your money just starts disappearing and may have a permanent loss. So let's go on to page 10 and talk about how we can deal with volatility as opposed to permanent loss risk. Okay, so things will go up and down in value if we're buying assets that have had a history of doing well. So we're talking about leading funds, blue chip companies, commodities that have had a long, reliable track record, precious metals, collectibles, but not diamonds. Diamonds are not something to invest in because there's too much too many people who are marking it up to make a profit, and we don't really know what the diamond is worth in a catastrophic market. Okay, we can, for people who are younger, below the age of 55, high inflation periods are a time to take some risk and to borrow money if you can buy really quality assets with borrowed money, because when inflation is taking off as it has right now, the cost of borrowing money is still cheaper than what inflation is cutting away. For anyone over the age of 55, that's no longer a strategy that would make much sense. Finally, whatever the situation is, one needs to be diversified. Never ever put all your assets in only a few places. We can't imagine ever putting more than 5, a maximum of 10% into any one investment or type of investment if it's something that is fairly unique, like gold or a specialized type of real estate. Okay, so see the quote there from Ben Franklin as we go on to page 11. All right, so despite everything being horrible and bad, here's a graph from the 1860s until the end of last year, until the end of 2021, and it's inflation indexed of what the most important marker for the American investment market is, which is the Standard & Poor's 500 index. You can see it can go wildly up and down, but if you have patience, it eventually goes back up and can do very well. So if you want to take a moment, you can see that right after World War I, in fact, all of the teens of the last century, the markets went down. In 1920 or 21, it took off again. It went down very strongly because of what happened in 1929. It recovered, went down again during the war years in the 1940s, and then had a very long run of going up until the late 1960s. It didn't go up again until the early 1980s. It crashed, as we all remember, right after the beginning of this century, and it crashed again around 2008, and then in the last 10, 11 years until 2021, the end of 2021, it had an unbelievably strong streak. The point of showing you this graph is that, as you know, things have not gone real well since the beginning of this year, and we need to expect that things will not go as well as they were over the last 10 years before the current crash. So seeing something like what happened in the 1970s in the US market, when the world was doing relatively well, but markets weren't, may not be unusual for the next period of time. So let's go to the next graph on page 12. And we can see what has happened since the beginning of this decade, since January 1st, 2020 until now, and this is inflation indexed. And hopefully you have it at home where you'll be able to see that even so the market has not done well since January, it is, even with the effects of inflation, it has not done as badly as people think. Let's go on to the next page. Oh, there we go. So we talked about the S&P 500 in the last 2 pages as an index of the overall health of the investment world. The investment world in terms of share markets is divided up into 11 categories, with a 12th category just recently been added. So you have the area of oil, emerging markets, etc. And you can see that through October 13th of last year, over an extended period of time, which industries have done the best. So oil did well, emerging markets did well, gold did well. That has not been the case since the beginning of this year. And in case you're interested in doing your own investing, on the right side is a list of leading exchange traded funds that you can use in the United States to go and specialize in any one of those areas. Okay, let's go on to page 14, where we will talk about the 12th sector, which is real estate. And here we can see that even this year, despite what the markets have done, real estate in the United States, Israel, and in most Western countries is still doing quite well. At the end of the day, real estate is where people can get the highest level of assurance of returns. Even so, it might not, as an asset class, be performing at the highest level at all times. I'll let you read this at home. Let's go on to page 15. Okay, there's 4 different ways that one can invest in real estate. Direct ownership of properties here in Israel, in the United States, Canada, Europe, etc. The main issue is, as we get older, to supervise repairs, to manage the properties in terms of getting rid of and acquiring new renters, etc., just is not a practical situation for most of us. We have a family member who wants to develop those skills. It might be still something worthwhile doing, because an older person can very often mentor the younger person so they can do a good job and create a family legacy of income. Here in Israel, there's another way of going, and it's called Kvutzot Rechisha, and that is group buying. And this is very common in terms of building apartment buildings with individual owners pre-buying their apartment through somebody who's organizing the group, the Kvutza. Unfortunately, it's very poorly regulated. Actually, doesn't seem to be regulated at all in Israel, and there has been a very high percentage of failures doing that. Some people have done great, and it means you can buy something at much lower than market value if everything goes well. But if it doesn't go well, you may have some serious problems and see the kind of risk we don't want to talk about. Private placements is something that's very common, particularly in Europe, the United States and Canada and Australia, to do investing. And you're going to hear a lot more about it in a little while from our guest speaker. These are where you have a regulated investment manager who is buying a piece or several pieces of real estate for a particular goal, is telling you what he expects to happen, whether there's going to be income, whether it's going to be for growth or a combination of both, whether you're going to specialize in apartment rentals or retail rentals or shopping centers or renting out to the U.S. Postal Service or something else. And we're looking for actors, the people who put it together, who have long and strong track records. And we will be meeting such a person in a little while. Another way to go is via the stock market. In the United States, there are several hundred REITs, real estate investment trusts, REITs, real estate investment trusts, that are available via the stock market. They won't get as high a return or give as high a level of income generally as a private placement, but they're even better regulated, and that's part of the reason why they don't get as high return, because their costs of doing business is significantly higher. But one can put together a portfolio of REITs and do it for income, do it for growth, do it for specific sectors. Like one of the ones that has been really hot in recent years is what are they called? Farms of servers, server farms. So there are people who are building or buying warehouses that are full of computers that are used to go and provide the services of Facebook and others. And they have marketed their shares, because it is real estate and equipment that they've bought, as REITs, and they often can give a decent income, plus there's the chance of growth there that has been pretty good until the beginning of this year. At this point in time, REITs and similar types of securities on the stock exchanges are getting very high rates of return. However, their share prices are still coming down. So if getting income is important to you, now is not a bad time to invest in these things, because the income will continue, and people will continue to need places to live. Hospitals will still need to rent their premises. Computer farms will continue to work for the foreseeable future, etc. So real estate investment trust is an area to think about in terms of investing. They can be sold and bought every day. Private placements will give you a higher rate of return if it's done with a reliable promoter. But your money is tied up for a longer period of time. Okay, let's go on to page 16. Okay, in terms of managing money, we have put together with Moshe Yonas, a stockbroker here in Israel, excuse me, a system so that many of your bills can be paid automatically. You have money in the country for emergencies, and you're taking extremely low risk in terms of losses. If you need more information on that, do not hesitate to be in touch with us. Let's go on to page 17. Okay. Cash management accounts for money that's left abroad. American cash management accounts for Americans and for non-American taxpayers provide the best way to manage your money and to take care of all tax obligations. In an American cash management account, you have checking, Visa debit card with all kinds of features, savings, tax advantage accounts like IRAs available, all the world of investments that are available from any exchange in the United States, and at a higher cost if you want to invest from stock markets in other countries. Everything is on a simple monthly statement, which is easy to follow. There are hardly any ongoing costs. It's tax efficient, and you can take money out of your account in Israel at almost no cost at the middle rate, what's known in Hebrew as the Shar Yitzchak. There's 24-hour free telephone call assistance if you need it. And for people who are not Americans, these kinds of accounts are revolutionary because they're not available in other countries, and it's hard for a non-American to understand what this is all about and how to use it. So that's why I'm bringing it up. And let's go on to page 18. Okay. This is just a little bit about ourselves. We assist clients in making important decisions by looking at the big picture and not telling you what to buy or how to buy. We're interested in solving problems like family offices do. In case you're not familiar with that term, a family office is an office that is created by very wealthy people to manage their finances. We try to use that model to help people solve their problems. We're not trying to push any solution or sell any particular product. We use a neutral family office approach rather than being investment marketers. We help you choose between bank advisors, investment managers, insurance-based investment solutions in Israel and abroad. And we work with many lawyers and accountants and others so that if you have a problem, we very often have several addresses that you can choose between for solving your problems. Okay, I got done a little bit faster than I expected. Let's go on to page 19. And if you need to contact us, those are contact details for the firm and for myself. And on the next page, on page 20, is the contact details for Yitzchak, our host today, and for Binyamin, who wasn't able to join us today. Okay, Yitzchak, I'm going to turn things over to you.
So first of all, let me thank Mark very much for your presentation. You carried the ball very well in terms of trying to go through and navigate these issues that we have today in terms of inflation. And we'll come back to, there's many questions that are coming on the chat, which we'll get to in a little while. So first of all, Mark, thank you in the meantime, and we'll be back to you with questions and answers following our guest speaker. Our guest speaker, as we mentioned earlier, is Larry Solomon, and we welcome him. He's the managing director of the company Melrose Solomon. He's been involved in investments in terms of real estate since the early 2000s, and he's worked with Barclays and UBS and all kinds of other places. And it's a pleasure to welcome him from New Jersey to our seminar. Larry?
Thank you, Yitzchak. I can just start by giving a little background. I grew up in the New York City area. My parents had the foresight to begin buying townhomes in Manhattan in the 1970s and 1980s, back when that was very out of style. Those townhomes back then cost about $100,000 a townhome, and now cost several million each. And that's sort of the world that I grew up in. My day job was in management consulting. I worked at McKinsey coming out of business school, then Barclays, then UBS. And then at some point I decided to focus more on the family real estate business. Over the last 10 years, we've started taking in outside money. We now have about 2 million square feet of real estate that we own, about 200 million, actually. As of Friday, we had a closing, thankfully, so we're at about 215 million worth of real estate. And so our focus, our investment thesis is as follows. We like to look at opportunities that are yielding cash day one. Generally, we focus on retail, office, and industrial. We tend to not go in main cities, so we're not in Midtown Manhattan or downtown Chicago. We tend to be in suburban areas that are near cities and sort of secondary, quieter markets. The reason is we think we have a better chance of getting a good deal if we go to markets that have fewer people like us chasing opportunities. Because we tend to make our money on the buy, and we tend to, we think, buy well, that gives us a lot of resilience and a lot of room for error. So even during the pandemic, for instance, our portfolio has generally performed quite well. We generally have had close to 100% rent collection, while leasing activity certainly slowed down in 2020 when the pandemic was really, at its strongest. In 2022, leasing activity has rebounded, and at this point, we're probably at the greatest level of activity that we've been across our portfolio. In terms of the cities that we focus on, we tend to look at cities where we think that the demographics are favoring future growth. So in the United States, you're seeing a migration away from blue states, blue meaning Democrat, and migration towards red Republican states, which have lower tax rates, lower tax rates and lower costs of living. So that has been our focus in the Midwest and the Southeast. We tend to focus on deals in the 10 million to 30 million size, which tends to be smaller than major institutions target, which goes back to your idea of trying to find good deals at the buy. We try to be very careful in terms of valuation and price. So we'll look at many deals a month, and we'll submit bids on many deals, typically, well below ask. And we're okay getting rejected on most of our bids and only hitting on a few because our whole philosophy is we don't have a fund. So we don't have any ongoing costs that we need to maintain. We don't have to put money to work. We will only buy generally good deals. So if that means we do several deals at a time or we do no deals at a time, that's okay. Because our thought is, as I was saying earlier, we make most of our money on the buy. We want to buy well, and we want to buy in a manner that leaves room for error and surprises. We always work with local on-the-ground talent. So we're based in the New York area. We don't know and we can't get knowledgeable enough for how things work in every state that we're located in. So we will always hire local third-party managers, firms like JLL or Colliers. Traditionally, sometimes we'll go with smaller local third parties, but again, these are people who understand how business is done in these jurisdictions. And then our job is to effectively stay on top of the managers, visit the properties regularly, review financials and so forth. Occasionally, we will rotate out a manager or a leasing agent if we feel that they're not a good fit for the property. But by and large, we try to be careful when we put someone into place, and then we sort of stay on top of them, so to speak, so that they are motivated to continue to do good work. We tend to buy and hold for several years at a time, if not longer. Our model is every 3 to 5 years we evaluate, should we do a cash out refinance or should we sell the property? Over the 8 fully realized transactions that we have done, we've averaged a 31% historical IRR. That's a technical term which you may not be familiar with, but it's good in summary. Some of the emerging trends we're seeing, which sort of speak to, and inform our continued investing. There's been a general movement away from dense urban cores post-pandemic, and which will favor our suburban focus, right? Work from home is becoming work near home. Many people in the United States have gotten used to not commuting. They want to continue not commuting, but both employees and employers don't foresee a long-term future of people working from their home. Instead, suburban real estate often offers cheaper solutions with larger footprints that are, you get to avoid some of the hassle of commuting to the city every day. Many of the main factors that encourage telecommuting don't really impact us because, first and foremost, rent in suburban office tends to be relatively inexpensive. So you don't have the same drivers, let's say from an employer's perspective, to downsize, right? Because the motivation for someone to downsize when they're paying $60 a square foot in Midtown Manhattan is not the same when they're only paying $15 a square foot in the suburbs. And the truth of the matter is, in some ways, just given the experience of the pandemic, some employers are looking to reverse the trend of shrinking footprints. In fact, they now want more space per employee. So that way employees are less likely to give each other, a contagious disease, or even feel more comfortable that that won't happen, even if it would not actually happen. I think we can go to the next page. So I'm now going to walk through a few example deals that we have done. I'm not sure if someone was trying to speak. We're going to walk through a few example deals that we have done, just so you get a sense of how we tend to operate. So in approximately 2.5 years ago, we purchased a property in Columbus, Ohio, 355 East Campus View. Occupancy was 80% and investment. Purchase price was $10 million. So this was really at the worst time of the pandemic, and we just thought it was a great opportunity. We bought it at about a 7.8 cap. Our thesis was the occupancy was definitely below the market. It was an attractive cap rate at day one. And the bottom line cost per square foot was quite low. Performance to date was very attractive. We successfully sold the property about a year after we purchased it, and 1 year return to investors was 70%. That's not our typical focus. As I mentioned earlier, we tend to hold investments for several years at a time, but we also try to take advantage of market opportunities where we see them. And this is one in which we just got in at the right time. And then when COVID was starting to fade from economic impact, there were a lot of buyers looking to invest capital they had stored up. One such buyer came to us and just gave us an offer that we could not refuse. Leah, you can go to the next page, please. Here's another example. This is a retail example, which we purchased in May 2019. This was a 40,000 square foot strip center right next to a Walmart in Madison, Mississippi. We bought this directly from a lender that had defaulted on this property. At the time of purchase, it was 87% occupied. Purchase price was $5.3 million, cap at 9.25. The reason why we love this deal is it was right next to the only Walmart in a very wealthy and growing suburb. It was a very attractive cap rate and below market leases. Performance to date has been wonderful. Our occupancy is now at about 95%. We negotiated a long-term renewal with the Dollar Tree store that was in the center. The To date, investors have received a 31% cash on cash distribution, and we recently did a cash out refinance. So investors will see a significant portion of their investment returned over the next year. You can go to the next page. Here's another retail deal we bought in 2019, 67,000 square foot. This we bought from a real estate fund that was growing much larger and decided they just wanted to sell some of their smaller investments, well, small to them, and that they were not very sensitive on the price they were selling it for. We were able to buy it for $3.9 million, which is an 8.3 cap at investment. This came with the opportunity for us to build our own building, an outpad. We did sell this after 3 years. Investors received 115% return on their money. And one of the reasons we were able to get the return we did is we developed architectural plans to develop this sort of unused portion at the front of the parking lot. So the next buyer will not only get the cash flows from the existing center, but they will be able to put up a new building in the front of it. So there's just an example of some value that we identified that hadn't really been pursued to date before our acquisition. I think I can stop here. Yitzchak, do you think people, we have a few more deals that I could walk through, but you may start to see some of the same patterns, which is generally we try to buy well. There's usually a reason why we think something is a good deal. Let me pause here, Yitzchak. I'm not sure if you want to open it up to any questions that people may have. If not, I'm sort of happy to pause here, and people can follow up with questions, of course, at any time after the discussion as well.
Okay. First of all, thank you very much. It was a very clear presentation in terms of your approach and strategy. So first of all, we can open it up to questions that people have in relation to real estate investments. One of the questions in terms of real estate that people, of course, since the whole topic tonight, Larry, is to do with the inflation today of people's concern. So how are these kind of your real estate deals, how do they fare in terms of inflation?
It's a good question. Generally, and I'm not a macro economist, but I know enough to be dangerous. Generally, inflationary environments tend to favor hard assets, right? So buildings, raw goods, and so forth, which just over time tend to be worth more, just by virtue of the fact that prices are going up. Real estate tends to do well in inflationary environments for two reasons. First, rents themselves, right, benefit from inflation because your tenants ultimately have more disposable money that they can spend, right? So if, just to use round numbers, right, if a hair salon makes $100,000 a year in profit and they can afford to pay you $20,000 of that in 2020, and fast forward 10 years from now, let's imagine just because of inflation, they're making $200,000 a year. So nothing about their business has changed other than the value of the dollar has changed. Well, that means that automatically they have another $100,000 of which they can pay you rent. So inflation tends to favor real estate generally from a rental perspective. The other benefit, of course, is the physical bricks, right? You actually own a hard asset. Over time, the cost to put up competing buildings goes up as inflation goes up, right? So if I'm buying something for $100 a square foot, and let's imagine I'm buying it for $100 a square foot, and right now someone can put up a competing product for $150 a square foot brand new, right? Well, in 10 years from now, if it costs someone $200 a square foot to put something up, then my $100 per square foot initial purchase, right, is that much more valuable, right?
Mm-hmm. Okay. Larry, we'll see which what questions may come up. At the moment, there aren't any other questions in terms of your approach with real estate.
Okay, great. Well, I thank you for giving me the opportunity to speak, Yitzchak, and look forward to fielding any questions which come up after the discussion.
Very good. Thank you for your time, and have a good day.
All right, take care now.
Okay. Okay, thank you very much, Larry. Mark, we're going to be now coming back to you. You did mention earlier that people should realize that there's nothing here that we're talking about that should be discussed as if we're pushing something or trying to sell something. We're not encouraging and asking anybody to make any decisions. I know, Mark, you mentioned it earlier, but I felt it was important that we should just reiterate it now.
Right.
In terms of some of the questions that we have, and people can keep now asking more questions as the discussion continues, and we are going to wrap it fairly soon. So if you have questions and you haven't yet chatted in, please do so now.
Okay.
One question is how to hedge against inflation, if it's possible.
All right. Do you want me to try to answer that imponderable question? Okay. We have clients who do various areas of investing, but because the markets have been poor, those who are invested through brokerage accounts are seeing that their money is mainly sitting in cash right now. And what I didn't talk at all about earlier was recession, and I'll come back to answering the question in a moment. But recession is something that has begun, but this recession is very different from recent previous recessions because the underlying economies in most countries other than the UK is still doing relatively well. And one of the basic parameters of a recession is when unemployment shoots up. People lose their jobs, particularly the poorest end of the economy, the poorest people in the economy. That hasn't happened so far. In fact, I was just talking to a client earlier and mentioned to her that right now at Ben Gurion Airport, 1/3 of the possible jobs that are available are vacant, which is mind-boggling. People are complaining that they're not getting their baggage quickly and that they're not being checked in efficiently. It's because they don't have the manpower. And as long as manpower is being utilized to the max, which seems to be happening here in Israel, the United States, and Canada, and in much of Europe, we don't have a classical recession. So people want to invest. The companies are solid, they're making money, but their shares continue to go down in value. So we go back to one of the things I mentioned earlier, that we can get astounding rates of payouts from Larry's programs and from certain REITs. That isn't good enough when you have a REIT that's being traded on the stock market, because the value of the shares is still going down. It's still not quite the time for us to go in and take advantage of capturing those high levels of dividends, and then to also be seeing either a level share price or a share price that is starting to go back up. So it's a good time to plan to invest. It isn't yet quite the right time to be invested if you're doing stock market related things. For someone like Larry Solomon, who has his nose to the grindstone apparently, and knows how to go and cherry pick properties, seems like now is the time to go and build up a portfolio. so that you are seeing returns coming down the road and fairly assured dividends. Okay, so there's a lot of stuff going on, but now's the time to be ready to pounce back into the market, but it's not quite the time yet. And a lot of it depends on what's going on with the war in Ukraine.
I have a question.
Yes, Jacques.
Hi, how are you?
All right.
Given the different level of inflation between Israel and the United States and Canada, for somebody living in Israel right now, what do you think the proportion of assets staying in Israel, in real estate, Kupat Gemel, whatever is available, and in North America, what the correct proportion should be, and what the proportion of cash in a portfolio should be? Two questions.
Yeah, those are two great questions. So let's take them one at a time. In terms of what should be in Israeli real estate as opposed to American real estate.
Not just real estate.
Okay, and shares and so forth. It all depends on the underlying product, the investment. I don't think we should look at the world today as Israel as opposed to non-Israel, but more important, do the products that you're looking at stand up to a world standard? Israel does a lot of things well. Other things are not done so well, particularly in the real estate area, where regulation is almost non-existent. But in the stock market, regulation is good, but the really good shares for Israeli companies are often only listed abroad because the Israeli market is so much smaller than the American and European market in terms of finding investors. Private investors don't go and buy shares if they are living abroad on the Tel Aviv Stock Exchange because it's just too small a market. So I believe you need to look at each investment opportunity and compare that to other ones, and not to be too concerned about what's in Israel and what isn't in Israel. Okay, so that's your question number one. Question number two, remind me, is?
What percentage of your portfolio should be in cash?
Right now, the more you can have in cash, the better, because we still haven't seen strong evidence that we have gotten to the bottom of the downturn. We're probably close to it, but a lot of it depends on what's happening with the war and England in terms of the new government coming in and other factors, so that we're not seeing the opportunities. There's a lot of tantalizing things that happen, like last month in August, a lot of people wanted to jump back into the market because it went up strongly, but at the end of the day, it came down again almost to the lows of the lows just a couple of months before.
Thank you.
Okay, Jacques, very good. The next question then, Mark, is an inheritance tax question. Is it correct that the U.S. will impose a tax on inheritance for people holding U.S. assets greater than $60,000, even for non-U.S. citizens and non-U.S. residents?
Okay, so if the person is an American taxpayer with citizenship, the millions of dollars that are used before you have to pay death taxes in the United States holds. However, those with green cards, those who are non-Americans and non-resident, the $60,000 threshold is there, but there are a number of very simple ways to get around it if you plan properly. And yeah, I don't know how many people are here on this seminar in that category, but you have opportunities to cover your taxes with life insurance, to buy non-US based securities, which means they're not part of the calculation for death taxes, and to go and hold your assets in America in trust or in corporations so that the death of the owner is not triggering the estate tax. So those are 3 ways to do it. Each person's situation is different. Sometimes it's very simple to dissolve the problem. Other times it's a little bit more complicated and costly.
Mhm.
And I should mention at the end that The Economist, the British financial magazine, Bloomberg, and others have done articles in recent years that the United States is probably the safest and best offshore financial center in the world today, that if you do it right, your money is protected at a higher level, and your cost for creating these kinds of tax shelters from estate taxes and other things is relatively cheap there.
Mhm. Okay, let's go on to some more questions until we have time to conclude. Next question to do with the REITs. One is asking, if I invest in REITs, what happens to the principal at the end of the contract?
Okay, so every time there's a distribution from a REIT, part of it will be income and part of it will be return of capital. So if you're holding a REIT for a long period of time, you're getting income, and depending on the REIT, it might be 10%, it might be 70% of the income is for tax purposes considered return of capital. It all depends on the type of REIT and how they're doing their accounting. You have to realize that if you're getting return of capital along the way, that's eating away at your principal for when you sell the shares. So 100% of your money when you bought the share is capital. And if you're getting back 90% of what you put into it at the end when you sell it, you have a capital gain on everything other than that 10%. In the United States, the capital gains tax is lower than in Israel in most instances. If you're a non-American, you're paying no capital gains tax in the United States on anything that grows, so it can be a good deal for you.
Okay, that's the last question that we have on the chat. Unless there's anybody else has any other questions, and if not, Mark, if you want to just perhaps summarize.
Okay, so several people contacted me before today's presentation and said, are you going to talk about anything other than real estate? And the answer is, as you've heard, that there's lots of things to talk about, but at this moment in time, there are very few things that are reliably returning a growth rate in terms of our capital. They might be providing income. The one area that has been strong is to find real estate promoters like Larry Solomon who know what they're doing. But in terms of the REITs that are listed right now, they're still tending to go down, but it's a good time to have cash available because hopefully very soon we'll see life come back and there'll be some really great opportunities there.
Terrific. All right, and we mentioned also that the office will be sending out other materials as well.
Absolutely. In the next couple of days, there'll be a major mailing to everyone who received anything today. If there's any others who want to receive it, just send Yitzchak or me an email and we'll add you to the list. And for those who will be seeing this later on via YouTube, they can request from us using the emails that are on the slides, and we will send them the follow-up mailing that was sent out earlier to everyone who participated with us live today.
Terrific. Mark, thank you so much. AACI, we thank you and everybody for participating, and we look forward to joining together at an upcoming seminar.
Okay.
We wish everybody a Shana Tova.
Yes.
Happy New Year.
Shana Tova. Good evening. Bye-bye.